Welcome to the deep dive. You send us your sources, and we extract the knowledge you need quickly and engagingly.
Hope so.
Today, we're diving deep into a set of really important documents. We've got some technical details and a presentation.
hmm
It's all about short-term climate scenarios from the Network for Greening the Financial System, the NGFS.
Exactly. And it's fascinating stuff. It gives us a glimpse into how central banks, financial supervisors, how they're thinking about the immediate future climate-wise and, its economic impact.
Right. So our mission today is to really unpack these NGFS short-term scenarios.
Yeah, understand what they are, how they're built, and crucially, what these different paths could mean for, well, the economy, the financial world.
Think of this as your shortcut, folks, to understanding a pretty complex but absolutely vital area.
Definitely vital.
Okay, so to get started, let's look at the group behind this, the NGFS itself. What exactly is it?
Okay, so the NGFS is a global network, basically. Brings together central banks, financial supervisors. As of March this year, 2025, it had 144 members and 21 observers. Quite a few.
Wow, that's substantial. And their goal?
Their main goal is really to show best practices, contribute to developing how the financial sector thinks about and manages risks related to climate and, well, the environment more broadly.
So pushing finance towards sustainability.
Ultimately, yeah.
Yeah.
They're working to encourage that flow of mainstream finance towards a more sustainable economy.
Got it. So the scenarios we're digging into are like one of their main tools for doing that.
Precisely. The NGFS climate scenarios are specifically designed to help financial institutions, understand and manage the various risks that come with climate change.
Okay.
They lay out these plausible future pathways. And it's really important to remember this, that these aren't predictions, not crystal balls.
Right, not this will happen.
No, exactly. They're more like hypothetical futures, designed to help us explore potential impacts, understand the consequences of different choices we might make.
And these are focused on the short term, you mentioned. What does that actually mean here? Why that near-term view?
Yeah, short term here means a 5-year window, so looking out just to about 2029, 2030.
Okay, pretty immediate.
Yeah, and the goal is to provide a quantitative assessment, actual numbers on the impacts we could see on the real economy.
Like jobs, production, that sort of thing.
Exactly, GDP, jobs, production, but also impacts on financial institutions, the banks, the insurers, and the broader financial system, all within that 5-year time frame.
And why is that so crucial right now?
Well, this short-term focus is vital because it helps everyone understand the immediate risks, the ones we need to prepare for now, and, the near-term consequences of policy decisions being made today.
Okay, makes sense. So how do they actually build these different future scenarios? What's the engine behind this analysis?
The modeling framework they use is, well, it's quite sophisticated. It has to be, really, to capture all these interconnected factors.
Right.
It looks at multiple dimensions, considers how changes in one area, say climate policy, can ripple through the economy, the financial system, those feedback loops.
And it covers both types of risk, transition and physical.
Yes, it analyzes both transition risks, that's their risk from shifting to a low-carbon economy, and physical risks, like, more extreme weather.
Okay.
And interestingly, in this short 5-year horizon, the model suggests that transition risk doesn't really have much immediate effect on physical risk.
Oh, really? Why is that?
Well, the physical climate changes we'll see in the next 5 years, they're largely already baked in, determined by past emissions, you see. Transition policies take longer to affect the actual climate.
Gotcha. So it's not just one massive computer model running everything.
No. It's more like a coordinated system.
Yeah.
Different, highly detailed models that work together, logically consistently.
So you need the big picture and the small details.
Exactly. They need to capture everything from the global macro view down to, like, specific impacts on industries in particular regions.
And you mentioned 3 key models in this toolkit. Let's get a handle on the first one, GEME3.
Right, GEME3. That stands for Global Multi-Regional Multi-Sectoral Computable General Equilibrium Model.
Okay, that is mouthful.
Oh, yeah. But think of it basically like building a giant SimCity for the entire world's economy. That's kind of what a CGE model does.
Okay, I can picture that.
It uses complex math to simulate how different parts, households, businesses, governments interact, especially when you introduce a big change, like a new climate policy.
And GEME3 focuses on?
It specifically focuses on the macroeconomy, the environment, and the energy system. It's dynamic, so it evolves over time based on investment and stuff. And recursive decisions now affect later periods.
Driven by things like investment, you said.
Yeah, driven by capital accumulation, investment decisions. and it assumes myopic expectations, meaning actors don't have perfect foresight.
Okay, so it's a detailed simulation. What makes it good for climate analysis specifically?
Several things. It can model impacts of carbon pricing taxes, trading schemes. It also incorporates how tech evolves
How so?
through things like learning by doing, like how solar panel costs dropped as we made more,
Ah,
and also through specific R&D spending and how tech knowledge spreads. Importantly, it also factors in how the cost of borrowing money, the cost of capital, and perceived climate risks influence investment choices.
that sounds incredibly comprehensive. Okay, what's the next piece? EIRIN.
EIRIN. That's a macro financial model.
Yeah.
So while GIM E3 gives that global overview, EIRIN kind of zooms in. It simulates economic dynamics at a regional level.
Like North America, Europe, Asia.
Exactly, those kinds of regions. It captures structural changes in economies, the macro consequences like GDP ups and downs, inflation, interest rates.
And how that connects to policy.
Yes, crucially, how all that interacts with government spending, fiscal policy, and monetary policy, what the central banks do. And it looks this for both transition and physical risks.
So EIRIN adds the financial layer within regions. What are some key features?
Well, it uses adaptive expectations, the idea that people adjust their views over time as they get new info. It models business investment based on expected returns, household spending based on like their savings buffer.
The buffer stock theory, right?
Exactly. It even models how banks create money endogenously through lending.
Hmm.
And it includes a Taylor rule for how central banks might set interest rates.
Interesting. Okay, global simulation with GEMI3, regional finance with EIRIN. What about the third one, CLIMACRED?
ClimaCred focuses specifically on credit risk, so the risk of loans not being repaid.
Okay.
It analyzes how the chance of companies defaulting, their borrowing costs, the value of stocks and bonds, how all that might change based on their exposure to transition and physical climate risks.
And it uses inputs from the others.
Yes, it takes the projected output for different sectors from GEMI 3 and the risk-free interest rate calculated by EIRIN as key inputs.
So ClimaCred assesses the credit implications based on the economic and financial picture from the other two.
Precisely. It simulates how a company's financial health might change under different climate scenarios and what that means for its debts.
Okay, three powerful models. How do they talk to each other? How does the information flow?
It's a sequential process, kind of like a loop. GEMI 3 kicks things off. It calculates a carbon price based on the scenario's policies.
Right.
It sends that carbon price to EIRIN, and it sends projected industry output levels to ClimaCred.
Okay, step one.
Then EIRIN does its thing, calculates the risk-free interest rate, and passes that to ClimaCred.
Got it.
Finally, ClimaCred runs its credit risk analysis and sends the adjusted cost of capital for each sector back to GEMI 3 for a second, more integrated run.
So it's iterative, it feeds back. That allows for those macro financial feedbacks you mentioned.
Exactly. That back and forth is really crucial. It helps capture how changes ripple through the whole system, the economy, and the financial side.
Right, it connects everything. Okay, now we understand the machinery. Let's talk about the actual scenarios. What are the main storylines they explore?
Okay, there are four main short-term scenarios. First one, highway to Paris.
Sounds optimistic.
It is, relatively. It envisions a pretty rapid technology-driven shift towards net zero by 2050. Assumes carbon pricing comes in as expected. Lots of green investment.
What else defines it?
A key bit is that some carbon revenues get reinvested into green initiatives, and importantly, investors expect this transition. They shift their expectations.
Okay, that's the smoothish transition. What's next?
Second is the sudden wake-up call. This one pictures climate action being delayed,
Oh.
then bam, sudden forceful policy implementation.
Uh-oh. Sounds messy.
It could be. This rapid policy shift forces a swift reallocation of capital, potentially triggering financial instability.
Okay.
They even use the term climate Minsky moment.
A Minsky moment, like a sudden collapse in asset values.
Yeah, that potential for sudden severe asset repricing.
Yeah.
Here, expectations shift instantaneously, and you see more stranded assets like coal plants losing value compared to highway to Paris.
So the risk here is the speed of the change, the disruption.
Exactly. It highlights the danger of delay. Waiting makes the eventual transition potentially much more disruptive, much riskier for financial stability.
That's a stark warning. Okay, scenario 3.
Third is disaster and policy stagnation. This one shifts focus to the physical impacts. It looks at the consequences of a series of compound physical risk events.
Compound events, like multiple things hitting at once.
Yeah, think heat waves, droughts, and wildfires together, or severe storms and floods hitting large areas. This happens across different continents, under a scenario where climate policies basically stay as they are now, stagnation.
So no stronger climate action.
Right. And these events are large-scale, continental. While the direct hit might be short-lived, the models show they can have persistent negative effects on productivity, on the economy.
So this highlights the cost of inaction on the physical side. What's the final scenario?
The last one is diverging realities. This explores what happens if emerging markets and developing economies lack the financing needed for a green transition.
Okay, a split world.
Kind of. The result could be repeated natural disasters hitting these regions harder. Disruptions to global supply chains, especially for critical minerals needed for green tech, and higher borrowing costs for these countries.
So a widening gap.
Exactly. A gap in climate policy between advanced and developing economies and physical risks become a much bigger, more immediate financial worry for emerging markets and low-income countries.
These scenarios paint very different futures. Can you give us a few specific examples of how these narratives translate into like actual numbers or assumptions in the models?
Sure. So in Highway to Paris, the models assume specifically that 20% of carbon revenue goes to subsidize green investments, and a hefty 80% goes to R&D for clean energy tech.
Very specific.
Yeah. Then, in sudden wake-up call, the carbon price is modeled to jump really sharply, exponentially after that policy shift. And there's a focus on the negative hits to high-carbon industries.
Makes sense. What about the physical risks in the other scenarios? How are they put in?
Okay, in disaster and policy stagnation, they simulate specific compound events. For instance, in 2026, they model a heat wave, drought, wildfire event. They call them HDW events, hitting each continent.
Wow. Everywhere.
In the model, yes, a representation for each continental region. Then in 2027, it's storms, floods events, SF events, again, in each region. They assume damaged capital gets rebuilt in a year, but the hit to productivity lingers, fading by about 50% each year.
And diverging realities.
There, they specify exact years and continents hit by HDW and SF events, and they set the intensity at what you'd expect maybe once every 20 years, a 20-year return period magnitude.
Those details really make it concrete. So running these scenarios, what do they suggest might happen to key economic things people track, like inflation or jobs?
Well, the implications are pretty significant.
Yeah.
For instance, models suggest central banks could face higher inflation from carbon prices, especially if the transition is delayed and then sudden, like in the wake-up call.
Stagflationary risk, almost.
Potentially, yeah. We also see different projections for unemployment across regions, the EU, Africa, Asia, the Americas, varying quite a bit depending on the scenario.
Any specific sector impacts?
Yes. For certain EU sectors, like non-ferrous metals, construction, agriculture, even making computers and electronics. The models show potential negative hits to production and exports in some of the more disruptive scenarios.
And how did these economic shifts ripple through the financial system?
The models capture several transmission mechanisms. A key one is reassessing credit risk for companies and governments. As the climate outlook changes, default risk can rise, changing risk premiums on bonds.
So borrowing gets more expensive for some.
Good too. Investor sentiment also plays a big role. A potential shift away from polluting or vulnerable sectors, leading to higher capital costs for them, and maybe more investment flowing to green areas, and that risk of stranded assets we talked about.
You mentioned the physical risk modeling is quite detailed. Can you expand on how they approach that complexity?
Yeah, they use this storyline approach, focusing on those compound events, HDW and SF. They use the Myriad database, which has info on past large-scale extreme weather events, to inform the scale and characteristics.
But it's hard to model perfectly, right?
Oh, absolutely. Scientifically, assessing the joint impact of different hazards across different scales is a huge challenge. NGFS aim to use publicly available data and empirical studies to guide their impact estimates.
What specific data do they use for the impacts of, say, heat waves or floods?
For heat waves, it's mainly about labor productivity. People just can't work as effectively when it's extremely hot. For storms and floods, it's damage to capital stock buildings, infrastructure. They use things like aqueduct flood maps and depth damage functions for that.
And droughts.
Drought impacts are often linked to production losses, especially in agriculture, using indices like SBEI and water risk data from CDP.
Okay, and these direct impacts, less labor, damaged capital, lower productivity, they get fed into
the GME3 model, specifically for that disaster and policy stagnation scenario. Then the CLIMACRED PHYS part simulates the knock-on financial effects on company balance sheets, debt valuation, even sovereign risk.
Okay. One last piece. Grounding these future scenarios, how do they set the baseline, the current policy's starting point?
Right, crucial step.
Hmm?
The models are calibrated to a baseline reflecting the world as it is, or was very recently, including current policies. For macro projections, GDP growth, consumption, investment, they mainly use the IMF World Economic Outlook from October 2023.
And current climate policies.
Those are integrated based on existing research, like work by Daphnalis and others. And then at the firm level, they use financial data from the Damodaran database to set parameters like typical debt levels, profit margins, depreciation rates for different sectors.
So it starts from a realistic picture of today.
Exactly. That's the anchor point for exploring those different future pathways.
This has been incredibly insightful, a real deep dive into these NGFS scenarios. For our listeners trying to synthesize all this, what's the single most important takeaway?
I'd say the key takeaway is that these NGFS short-term scenarios offer a really detailed, interconnected way to analyze the potential economic and financial fallout from different climate paths just in the next 5 years.
Yeah.
They really highlight the significant risks, both from the transition we need to make and from the physical climate impacts that are, frankly, already starting to bite.
And the complexity shows it's not simple.
Not at all. The
Yeah.
fact they need multiple integrated models just underscores how multifaceted this challenge really is.
Absolutely. A powerful reminder of how intertwined our economy and climate are, even in the near term. So for you listening, maybe pause and think. Which of these scenarios feels most plausible right now? Highway to Paris, sudden wake-up call, disaster and stagnation, diverging realities.
Yeah, it's a sobering thought exercise.
And maybe more importantly, what actions by governments, companies, financial institutions, maybe even us as individuals, could help steer us away from the worst outcomes? Think about policy, tech, finance. They all have a huge role to play.
Definitely. And if you're really keen, we'd absolutely encourage you to look at the original NGFS reports. There's obviously even more detail there. It's a critical area to understand.
Couldn't agree more. Thanks for joining us for this deep dive. We hope it's given you a valuable shortcut to understanding this vital topic.